Hello, everyone. Welcome to Money Hour Radio, a show where we try to help you grow your money, pay less taxes, and have a beautiful retirement. I am one of your co-hosts, Ben Barzideh. As usual, I have with me my partner, my esteemed co-host, Matt Nadeau.
Hey, everybody.
We are both founding partners and wealth managers at Barzideh and Nadeau Wealth Management, a comprehensive financial planning firm located locally right here in Barrington. And we are fiduciaries, and as an independent, family-owned firm, we truly have the freedom to focus solely on your interests, not some corporations or those shady private equity companies that are buying everything up these days.
And of course, we want to take a moment to say hi to all of our clients who are listening today. We know you're listening. You tell us every week. We really appreciate it. And of course, what we really appreciate is the trust you place in us. And of course, we love every one of you. And we have a great show. We're going to try to pack in a bunch of big topics. A lot's going on. We're going to talk about gold. It's been a little while since we've talked about gold because, boy, we're seeing it might be on the verge of surging again. So we're going to talk about that. I guess we can't go a couple of weeks without talking about SpaceX. We're going to talk about tech and other Mag 7 companies with their recoveries, and then cloud companies specifically being maybe the next piece in the AI boom. And then later in the show, we're going to have a really good strategy for some of you that's called a 72T program. And that's an option where if you need income before you're at retirement age of 59 and a half, you can somehow get some of that income without paying the big fat penalty. And we're going to talk about how that works as well.
All right. It's going to be such a good show. Let's get into our first topic. Gold may be ready to surge again. It's actually bottomed out recently and gone sideways in what we call a coil pattern on the charts for the last few weeks, and it's potentially building up strength for the next surge and movement up. And in fact, the last two times it did this, it went up about 35% in January through June of 2025, and then over 60% between September of 2025 to February of this year. And the reason it looks like it's about to surge is because the dollar is set for a decline, which usually boosts gold. They go in opposite directions. And if the market begins to more fully believe that the Fed is behind the curve on inflation, then the debasement trade that has dominated markets in late 2025 and early this year will re-engage as hard assets rise as the dollar declines on inflation erosion fears.
I know some of you are out there saying, debasement, what is that? So the debasement trade, that's where investors actually shift money out of fiat currencies and government bonds and get into hard assets. So we're talking, let's go move into gold or silver or real estate or like maybe even Bitcoin. And the idea is to protect purchasing power as monetary expansion and rising debt start eroding currency value. So one of the things that we do is we don't just buy gold and hold it. We actually have a process with a signal for gold, and we actually got out of gold for our portfolios a few months ago, and now we're eyeballing a good time to get back in, and we might be getting close, Ben. So I guess to be continued. You guys will hear here when we decide it's the time for us.
No doubt. All right, now let's pivot to my favorite. Oh gosh, you know how I love this stock, SpaceX. And guess what? It may finally be bottoming out. And SpaceX just this week had its first and very much anticipated earnings report. It came out late Tuesday, and it was the first one since going IPO a few weeks ago. It actually beat on earnings, but it also took a hit because AI capital expenditures was higher than anticipated. Where have we seen that before lately, right? That story? Yeah. Everywhere, right? All right. However, the other darling, NVIDIA, also made some news on SpaceX's earnings call. How come? What happened? Well, it's because NVIDIA's artificial intelligence chips got a major endorsement from none other than Elon Musk, and he touted NVIDIA's upcoming Vera Rubin chip architecture as the best and said that SpaceX has decided to build exclusively on NVIDIA from now on.
It's like, whoa, as if NVIDIA didn't already have enough going its way. It's like, man, it's like overachiever, like the kid in school. You're like, gosh, I'm sick of him.
I know. What's going on?
And, you know, of course, it's one of the Magnificent Seven companies. It's part of a lot of our clients' portfolios, which is a big boost when that kind of news comes out. So, you know, the nice thing is we talk about this with IPOs and hot IPOs. They go through these cycles at first, and maybe it's now bottoming out. So it really has started to maybe hit that bottom and a basin of what we call on these technical charts. So we'll see.
Hey, you know how I love me some SpaceX, right? So, all right, let's switch to tech.
Yeah. So we just talked about Mag 7. Tech's been a big thing. Companies are starting to recover. And, you know, last week we talked about semiconductors and other AI stocks are crashing. And, you know, we said last week it was the start of a good day. We were hoping for more. Well, things change quick these days. It's been exactly the opposite this week. And that's why we utilize a process to help us identify when it's time to potentially stay put or sell out of various areas in the market. And of course, as we said last week, it wasn't time yet to bail on tech. And sure enough, it's still starting to come back pretty big lately.
No doubt. All right. So this segment is going to be a really interesting segment. And we're going to talk about, are cloud companies next up in this AI boom? Is that the next investment opportunity that's going to take off? So semiconductors and memory company stocks have been by far the undisputed biggest winners from the AI boom, as demand for chips and memory have exploded as the AI data center build out accelerates. But cloud companies may be next in line to outperform. Cloud storage is analogous to memory in its role in AI operating efficiently. In servers, memory acts as a stoplight for processor speed. So here's an analogy. Imagine you're driving a Ferrari in Manhattan, which will equate to as the latest NVIDIA, Taiwan Semiconductor, AMD, basically those chip companies. So the Ferrari could go very fast, but restrained by memory speed. And if the chips are the car, the Ferrari, and memory is the road, well, then cloud is the gas station. And we can have the fastest chips in the world, basically the fastest Ferrari, and we can have the flattest, smoothest road, which is the latest memory. But if we don't have a gas station with high quality gas, guess what? We won't get the most out of the car.
And what's the analogy for the money I need to buy the Ferrari? So and that's how this is with AI, right? Memory's critical to AI. So too is ample advanced cloud storage. And that's where the new surge in demand is. And we saw that with earnings last week with Amazon and Microsoft, because the earnings showed that the demand for cloud storage and the compute power could be really that next constrained resource for the AI boom demand. So for both AWS, Amazon Web Services, and the Microsoft Cloud business, revenue growth was substantial. So both companies reported approximately a 40% revenue growth just in their cloud business from a year ago, and with very strong margins. So with growth like that, the cloud is now a major contributor to revenue. Perhaps most importantly, is from a demand standpoint. Microsoft reported an 84% year-over-year increase in a cloud backlog. It's basically these external orders waiting to use their cloud. It's more than $678 billion. It's huge.
Just massive. And interestingly, while cloud is essential to the AI build-out, the cloud stocks have actually lagged the other infrastructure names this year. However, since the top in tech, back on June 22nd, that's actually reversed. So bottom line, as demand for AI infrastructure evolves, cloud storage and availability may become the next bottleneck in the AI build-out. So if the cloud companies could see demand surge, just like we saw with semiconductors 3 years ago and memory earlier this year, boy, that could be a big opportunity. Yep. By the way, if your advisor, is your advisor talking to you about this? That's the question for the audience. Do they ever bring you analysis like we do? If they don't, well, what would you think it signals about their knowledge or expertise, or lack thereof, we should say? You don't have to settle for that. Your money is too important. Do you want to work with knowledgeable advisors who have a dynamic investment strategy that looks to capitalize on changing trends?
Well, guess what? We offer one. That's right. And of course, if you've listened, you've heard about our actively managed tactical investment process called Advance and Protect, which of course is the way that we manage our client portfolios, where we utilize sophisticated research using quantitative and technical analysis to really measure the dynamics of the market under the hood. So when we're identifying these trends and these dynamics, if the risk in the market's low, we want to be fully invested in stocks. We're going to intelligently diversify into areas of the market where we're showing the highest level of momentum and strength, and we're going to avoid areas that are deteriorating. But we watch and monitor our investments every single day so we can quickly react if it's necessary. So if things deteriorate, we'll get defensive by actually selling out of the market or going heavy into bonds or cash while we wait for things to improve. And we'll literally get out of the market 100% in really bad times if conditions warrant it. So if you want to learn more about our investment philosophy, please reach out to us at bnwealth.com or call our office at 847-780-2980. All right, don't go away. We're going to come back and talk about a 72T program. Welcome back. Thank you for tuning in. This is Money Hour Radio, a show where we help you try and grow your money, pay less taxes, and of course, have a beautiful retirement. And I'm one of your hosts, Matt Nadeau. Have with me my esteemed co-host, Ben Barzideh.
Hello, everyone.
And we're both founding partners and wealth managers at Barzideh and Nadeau Wealth Management. It's a local, independent, comprehensive financial planning firm. We're located right here in Barrington, and we're here to help serve the greater Chicagoland area.
And before we move on, we just encourage you to like and subscribe to our YouTube channel on moneyhourradio.com. That way you get the latest episode as soon as it comes out. All the previous episodes are on there as well. And then we have a fantastic weekly economic commentary. It's called the 5-Minute Market Brief. It lets you know exactly what we're seeing, what we're analyzing. You can subscribe to that. It's completely free on bnwealth.com. All right, let's talk about 72Ts, Matt.
Yeah. And it's something that's got a weird name, right? 72T, but it's like surprisingly useful. And it's actually, they use that 72T because it's from the IRS code. They have so many different different codes in there.
No doubt.
But what it really is let's say you're under the age of 59 and a half. And you need to start generating income from your retirement accounts. So that little known section, 72T of the IRS tax code, can end up saving you thousands of dollars. And I know it kind of sounds like military equipment or something where it's a tank or a fighter plane. Oh, all right. I digress. Let's jump into what it is, Ben.
You've been watching too many military shows, Matt.
I know.
All right. So what exactly is a 72T? Well, normally if you pull money out of your IRA before you're age 59 and a half, guess what? Your favorite uncle, Uncle Sam, says, thanks for taking out your own money. But here, I've got this nice 10% early withdrawal penalty for you. And that's because the IRS likes to encourage people to leave retirement money, well, for your retirement. But as we all know, life doesn't always follow the script. Maybe you retired early. Maybe your company offered a buyout. Maybe you've accumulated enough assets that work has become optional. Or maybe you just hate your boss. You know, that happens a lot. Regardless, that's where a 72T can come in.
So if that's us, we'd have to hate ourselves a lot, right?
Yeah.
All right. So here's the thing. It can be complicated. So listen closely. We're going to try to make this a little easier. I mean, if there's one thing the IRS loves doing almost as much as collecting our taxes, it's trying to confuse us as much as possible while they do it. So I guess I kid, kind of, not really. I think they do it on purpose.
Well, guess what? The more complicated tax code is, guess what? The more you need CPAs and attorneys to help you navigate it, right? So I wonder why they keep making it more complicated.
It's all a big cabal. They're working together to make it lucrative. So a 72T, and it's officially called a substantially equal periodic payment program. So what it does, it allows you to take money out of your retirement account before age 59 and a half without paying the 10% penalty, but you have to file some strict rules that are set by the IRS. So this strategy can be an excellent income solution in the right circumstances, but it requires careful planning because mistakes are easy to do and it can be quite costly when you make a mistake. So we're going to come back to some of those mistakes and penalties in just a bit.
Now, there are 3 methods for calculating how much income you need, these 72T payments. And it has to do with the annual withdrawal. So the method number 1 is called the required minimum distribution method, the RMD. And this is a flexible option and actually yields the lowest amount of income out of the 3 methods. What happens is each year, your payment is recalculated based on your account balance and your life expectancy. If your investments do well, guess what? Your payments could increase. If the market has a rough year, however, you get less money. So the upside is you're generally withdrawing less money, which would give your investments more opportunity to recover. So if you don't need a lot of income, if you just need a little bit, this may be the one for you. But the downside is budgeting gets really interesting when your paycheck is bipolar from year to year, right? Most people don't want that.
Well, and that's why they call it the RMD method. It acts similar to your required distributions in the future when you're age 73. So method 2 is actually called the amortization method. So now is where you would want to think consistency and a much higher level of income. So this method calculates one annual payment, and that's generally what you're going to receive every year going forward. It's really like putting your retirement income on cruise control. So people who like knowing exactly what's coming into their checking account each month will often gravitate towards this method. And again, people who need higher income like this method as well. The downside, payment method's always going to stay the same. Even if, let's say, the stock market decides to have a crash and you lost a bunch of money, or maybe things change and you don't need as much, you're stuck with this payment.
No doubt. So then the third method is called the annuitization method. And finally, it sounds kind of complicated, but honestly, it kind of is. This method uses IRS mortality tables and an annuity factor to calculate your payment, but it's very similar to the previous method and method 2. It actually yields a similar higher level of income, and the payments stay level each year, just like number 2. It basically has the same pros and cons too. Payments are higher and consistent, but if the market tanks, you're continuing to sell investments low to create the income, and it makes it harder for your account to recover. And most people tend to choose option 2 or 3 because it yields higher income and don't really care what we call it. I don't know about you, Matt, but I've noticed people don't really care how the sausage is made, right? They just want to know, hey, how much can I take? Give me my money.
It's like at the ball game. I just want the hot dog. I don't care how it's made.
Yeah.
So here's some important rules. We've been talking about the methods, but there's some things you really got to think about because it's not something that you can just turn on and turn off and stop whenever you choose. If you botch it, it can have some huge implications and, of course, cost you a ton of money. So one thing you really have to remember is once you start a 72T plan, generally, you've got to continue taking those payments for whatever is longer, 5 years, or until you reach age 59 and a half. So let me give you an example. Let's say you start at age 50. Now that means your payments generally have to continue all the way until you get to age 59 and a half. Now let's flip the example. Let's say you're doing it at age 58. Well, now you have to wait at least 5 years to, at least age 63 generally, because 5 years is longer than reaching age 59 and a half.
Warning. You know how you said there's many ways to botch it, Matt? Well, guess what? This is what we mean. If you change the payments at all by doing the following, maybe you take too much money. Maybe you take too little money. Maybe you miss a payment. Maybe you add an extra distribution. So you need some extra money, you just take more out. Maybe you add an extra deposit to the account. Maybe a rollover comes in you weren't expecting. You change the frequency of the payments. Basically, if you do anything to change the annual amount that's going to come out, it can cause the IRS to retroactively assess the 10% early withdrawal penalty on all prior distributions. Say what, right? Yeah, that's like the IRS coming back and saying, hey, remember all those penalties you thought you avoided? Yeah, we'd like those now, along with interest too, by the way. So, of course, nobody likes surprises from the IRS, so don't go doing this without professional help.
Yeah, that is, for some people, the biggest surprise. You get hit with that. So let's do an example, walk you kind of through this. And we're going to give you a real life example of a client where we've helped do this 72T program for. So we'll just use the name Dave here. We won't give out more than that. And he's 53 years old, or he was 53. And he'd worked for 30 years. And he had a healthy company 401k. It was worth $1.2 million roughly. And his wife is a teacher. Her name's Beth, and will have a good pension when she retires in the next couple of years. He has 2 grandkids. He loves to fish. And in fact, so much that he has a fishing boat. Remember this, Ben, where his wife refers it to the other woman.
Oh, yeah.
So anyway, he wants to be done with work. He's like, I'm done with this. He has no interest in attending another Monday morning staff meeting or a conference call with corporate. So he came to us and he said, hey, I want to retire ASAP. What can I do? I need income, but all my money's in this 401k. So we ran some reports for him, including a staple one, where we looked to see how much he's going to get from Social Security. We ran the strategies where, for his case, it was recommend till age 70 to start. But then he needed some money. He needed about $40,000 a year in order to retire and bridge this gap while his wife, Beth, is still working and will do so for a few more years.
So here's what we did. We ran a 72T report for him. It showed the amortization method could yield a payout of around 5%. And since 5% of his $1.2 million would yield about 60 grand a year, guess what? He only needed 40. So we recommended the following strategy. Once he retires, he can roll 1.2 million of the 401k into one IRA or even multiple ones. So we rolled 800,000 from one 401k into a traditional IRA for him. That kept the taxes deferred. We set up a 72T on that. That allowed a 5% income stream, which got him his 40 grand a year. And then the rest of the 400k remaining as 401k, we rolled that to a second traditional IRA. But since he didn't need income from that, we did not set up a 72T program. So no restrictions on that. We could always set one up later if we needed it. And guess what? Dave is now retired. He receives predictable annual income, and he spends all the time he wants playing with his grandkids and fishing. So guess what? As with any financial planning strategy, Matt, we don't recommend doing it on your own, right?
Yeah. And listen, 72Ts aren't for everyone, but you really need a professional to work with this. And if you're in need of a qualified professional financial planner, give us a call. We'd love to help you look over your goal, your financial situations. We're running out of time, but if you want to learn more, reach out to us online at bnwealth.com or call our office at 847-780-2980. We're out of time, and we'll see you next week.
God bless everyone.